Hello, agentpreneurs, and welcome to the Daily List Report. As always, I'm Randy Shiozaki, one of the co-founders of ListReports and your host for this show. Welcome back. Thank you so much for watching. We've got, as always, another great episode. We've got George Ratiu, senior economist at Realtor.com, back on the show. He's been on a ton of times. He's honestly just one of my absolute all-time favorite guests, and he's here to give us all of the updates on what's happening in the market from a data perspective, from an economist perspective. He has an amazing background. Prior to Realtor.com, he managed research programs at the National Association of Realtor. He's been quoted and highlighted all over the place. The Journal, Bloomberg, ABC News, CB News, New York Times, you name it, etc. And he's a delightful human being. So while you're here, please consider subscribing to our channel. Click the little bell so you're notified of all future episodes. What we're going to cover today is tied to some of Realtor.com's publications that George leads. So the weekly housing trends view, which I have up right now. Here's the most recent one. And if you scroll down on this page, and again, the links are below, so click on them, you can actually subscribe to this newsletter. And it's really helpful that you start to make sure that you're looking at this from a scientific, from a data, from an economist perspective. And sometimes I know that can be scary, but George, I think, makes this stuff really accessible. And of course, Realtor.com also has a YouTube channel, so please also subscribe to them and click the little bell so you're notified of all of the great content that they put out there. So without further ado, let's bring George on. George, welcome back to the Daily List Report.
Thank you, Randy. It is always a joy joining you and joining your agents. And this year, there's so much to talk about.
So much to talk about. I feel like I could have you on every week and we would fill up 30 minutes or an hour easily with all of the things that are happening.
You're absolutely right. In fact, sometimes I joke that if I get any more, neck snapping twists and turns to the year, I'm going to become a contortionist before long.
Sorry, I just had this visual image of you, as a contortionist. I don't know, making economic forecasts. It was quite a sight, actually, George. Thanks for that. So, George, again, as we've just said, right, as always, there's a lot that's happening right now. Here's kind of a kickoff topic for us, and then we'll see where this leads us and what we want to talk about today. Typically, right, when you come into the fall, the market changes, right? Kids go back to school, the weather starts to get cooler, the snow starts to fall, and the market shifts pretty dramatically, actually, typically in a buyer's favor, because the people selling then, it isn't the peak time to sell, generally speaking, right? And so the buyers coming to the market have more options, and the people who are selling probably are selling for a reason because they couldn't wait. So there's all sorts of dynamics. But this year, I think, is starting to look a little bit different. And I'd love to start there. And let's talk about what you think we can expect coming into the fall and winter months here.
It's a great point, Randy. And you're right. We are now basically midway through October, a time when, historically speaking, markets were much slower. Exactly as you said, most families with school-aged children by now would be pretty much locked in place, fully engaged in the school year, wherever their school district of choice was. So they would have moved easily between roughly May and until even August. What we're seeing this year is a departure from that historic trend, in large part really driven by two main factors. Number one, I would say the coronavirus pandemic. We had obviously the lockdown in the spring, which literally shifted the entire buying year, moving it obviously well into the summer and past it. So I think that's still playing a role. The other thing that I think is just as important are the interest rates. So mortgage rates remain really low, near historic lows, and that has really motivated a lot of buyers to continue shopping. And I think this is an important distinction here, because you think about the fact that yes, we can chat about the economic side, the unemployment situation, so on. But for buyers who still have jobs, they had literally 6 months of generally no commute if they work from home. And so they've been able to save more money. With those savings and the low interest rates, they've been able to go out and look for homes, in fact, even stretch a little bit their budgets. What they're really running into, and as we chatted before on prior sessions about, the supply issue was a real challenge, and it continues to be so. So the fall, now that we're already into October, what we're seeing, since we track the the market on a weekly basis, data we have from Realtor.com, what we're seeing really is continued strong demand. And you see that in the number of listings. So total listings for this last week were still down 38% compared to a year ago. Total listings have been declining by double digits year over year for months. In addition, because of the tight supply, prices now are accelerating at almost 13% higher compared to a year ago. And to me, what's really interesting and showing some, to me, clouds of concern is the pace of price growth is outpacing incomes. So when you look at wages, they're going up about 5% or so. So prices are more than double the speed of wages when you count so far this year. And that to me, as I mentioned, is real cause for concern because we're right now in a place where the lack of affordability, particularly for first-time buyers, is beginning to outweigh the benefit that lower mortgages provide.
George, can I ask you a kind of a dumb question here? I think maybe, which is you talk about the price increases, right? So median list prices grew 12.9%, right? So you said almost 13%, and I think affordability is an issue in lots of places. That's for sure. We're in Southern California, and it's insane. It's crazy. And so some of that is offset by the low mortgage rates, right? Some of that is driven by the lack of inventory, right, and the demand that exists. Where is, I guess my question is, where is that tipping point, right? Do you know what I mean? Where is that tipping point? Because mortgage rates certainly are a contributor to it, but so is the demand. And so I'm just trying to reconcile those two. When you say that you see some clouds forming, it's really a function of both of those things. Is that right?
Absolutely, and to encourage you, that's definitely not a dumb question. It's a very smart one.
Thank you.
Absolutely, you're right. In fact, to me, when I look at the market, exactly to your point, the drivers of this activity obviously are several, but mortgage rates very much play a role. And so these mortgage rates have, combined with the tight supply, have pushed prices where they are. So in my view, the tipping point, we're very much approaching that tipping point. And what do I mean by that? When you look at the progression of the year, we saw prices back before the coronavirus pandemic set in mid-March, prices were growing on a yearly basis about 4.5%.
Yeah.
And so we saw the growth really stall during the lockdown, but then it really picked up. And even without the lockdown, if you started 4.5% growth in February, where we are today at 12.9, it shows you what an incredible trajectory prices have been on. And to me, why I think we're close to a tipping point is the price trajectory is more than double the pace of incomes. So really, in a sense, we're soon going to run out of fuel for these prices. I mean, people can only stretch so far. And where the rubber meets the road is because most buyers come and to the market with needing to borrow funds, right? So they approach a lender. To me, in the lending process is where this tipping point will be noticed. Partly because lenders will only qualify a buyer based on their income, their credit score, and existing debt, right? So even assuming you have an excellent credit score, you have very little existing debt, your income will play a tremendous role. And so if your income is not keeping pace with the price growth, obviously at some point the volume of credit availability is going to dent the number of buyers. And we're already seeing that. When you look at Mortgage Bank Association data, we've seen at least 2 quarters of tightening credit availability. Lenders have already pulled back, and this was already past the point you may remember early in the year when they moved FICO scores to 700 and above.
I did, yeah.
When they moved
and cut
down
jumbos for a while. For a while, jumbo loans were off the table.
That's right. And remember the down payments, they started pushing towards that 20% mark in a lot of conventional loans. So I say that from my perspective, as credit continues to tighten, the number of buyers who will be able to qualify for a mortgage is going to decline.
Yeah.
And so, from my perspective, that's where I see as we move into the winter, not so much the fall. I think the fall will still see a solid market. I think September's data will show sales still advancing. But as we move towards November, December, and even January, I think we'll see a moderation in activity, which obviously will be an interesting indicator for 2021.
Interesting. George, let me ask you another question. I'm going to see if I can formulate this question. It's kind of along these lines, right? All of the smart people like yourself that I talk to don't foresee any sort of cataclysmic market crash coming. That doesn't mean that prices won't decelerate or decrease, right? Just we don't see anything cataclysmic. And one of the reasons for that, I think, as you've stated, is the tremendous amount of equity that we have right now. 4.5 trillion. Is that the correct number, ballpark?
Mm-hmm.
Okay.
Right.
And I think you told me that a third of homeowners in America own their home outright, which was a shocking statistic to me. Politics aside, right? The president says that we're in a V-shaped recovery, and personally, I don't buy that for a moment, right? I think we've talked about this. It feels like a K-shaped recovery. There are people. So for those of you, who are watching right now, and by the way, I'm no expert. George is be much better explaining this than I am. But the idea behind a K-shaped recovery is that you've got some people who are on the upper part of the K, and they're doing just fine, right? Financially, at the very least. And you got people on the down slope of the K who aren't. And so, my question for you, George, as it relates specifically to the housing market, is a lot of the people who have lost their jobs, a lot of the people who are, really hoping that there's an additional stimulus package that's passed, were lower income earners, right? These are people that were working at the restaurants and the concession stands at the games and all of the things that aren't happening right now. Like, they have been disproportionately affected by that. And those people, I would guess, are also disproportionately renters. So I guess my question is there sort of this weird sort of shield around the housing market, because most of the people on the upper part of the K are sort of in that sort of contained in that ballpark, and the people who are being disproportionately affected may not affect the housing market as much, at least directly, because they tend to be more renters. Does that make sense?
Absolutely. And I think that's a very insightful question. If anything, is at the root of a lot of, I would say, concern and tension in policy circles today. And so to answer your question, I think that indeed you put your finger on a very topical issue. When you look, and just to kind of wrap some numbers around it, look at the fact that every week for the last several months, we have had over 800,000 Americans lose jobs, right? When you look at the weekly unemployment insurance claims, you generally have two big numbers. You have the initial claims, right? Americans who that past week lost their job and had to file for the first time for claims. And then you have the continuing claims. The number of Americans who have been unemployed and are still drawing a benefit. That initial unemployment claims number has been over 800 for literally months, right? It was really high, right? As the lockdowns happened and a lot of companies furloughed employees. To me, we're almost 7 months past the initial inception of this pandemic, and to have a number that still exceeds 800,000 per week is tremendous. I mean, I think we've seen it for so long, some people have become a little immune
to
how significant. Consider the fact that historically, the historical average runs around 200, 250,000 a week in a healthy economy. We're almost, 3.5, 4 times that level. So to me, that tells me that, to your point, there's a lot of pressure on Americans financially. And you see that in the news, right? The airline industry is still under pressure. The travel industry is still under pressure. And some of these are spilling over with a lot of cases still flaring up. To your point, restaurants, movie theaters, retail stores, the sectors that are being impacted by this and the number of bankruptcies still tell us that the economy is nowhere near where we would, number one, hope it would be by now, and also point to a much longer road than we initially anticipated. So to your point, is the housing, in a sense, in some of a, at least I would say, defensive bubble, right? Traditionally, when you refer to bubbles, you say,
Yeah,
well,
it's the
price
wrong
bubble.
word. Poor word choice on
Sure.
my part.
No, it's okay. All I'm saying is I think it's in a defensive bubble because policymakers, recognizing the severity of this, moved quickly to put in place measures, right? We had the forbearance plans that in essence gave homeowners who faced hardship from this pandemic, 2 180-day periods to basically work with their lenders and postpone their payments. And literally, since we're mid-October, we just cleared the first 6-month period. And interestingly, based on at least the Mortgage Bankers Association data, we saw the number of mortgages in forbearance, the share decline, which in a sense is good news. It means that a lot of people have been able to manage that. Interestingly, the number of delinquencies and those in forbearance extensions has actually gone up. So those who are still in forbearance and they need an extension into the next 6-month period actually went to roughly 70% share of all mortgages in forbearance. So clearly there are some signs of distress and lingering distress. But to your point, on the rental side, we're seeing that play out right now. Yes, there have been some eviction moratorium put in place in the early summer. They got extended into the fall. This last month, the CDC passed a regulation, which is now being challenged in court, to continue the moratorium until the end of the year.
Right.
The trouble with that is that rental protections vary state to state, jurisdiction to jurisdiction. And what's I think really difficult is the CDC moratorium didn't exempt tenants from actually being subject to not only due rent payments at the end of this moratorium, but possible fees or interest payments that the landlord could collect. And I think compounding that is that the landlords themselves didn't get any protection.
No.
Most of them have obviously financing, so they are obviously liable to their lenders. So in essence, it's a very tough catch-22. All I'm saying is, to your point, I think that for a lot of renters, they've seen some of these protections not be nearly as strong as homeowners. So I think the rental market is going to feel a lot more pressure. For homeowners, realistically, we have until roughly the end of March 2021 before, when the forbearance program expires, before we're going to see any real numbers wrapped around the rate of delinquencies. So I think when you combine that with record equity, rising prices, realistically, even if you're a homeowner who's, even 6 months from now facing financial hardship, you could theoretically list your home for sale on the open market, get a good competitive price, be able to salvage your down payment plus any principal you've accumulated, move into a rental, and then go out and buy a home again when your finances improve.
Right.
A very different situation than a lot of
Exactly.
homeowners found themselves back in 2007, 2008, 2009. So a very maybe long-winded answer to a very important question.
No, I think that was really helpful, George. And one of my goals on this show is to selfishly grow my own knowledge, but by extension grow the knowledge of everybody who's watching. And there's one other topic that we didn't discuss ahead of time, so I'm just curious to get your take on this. I remember as a kid growing up, sometimes you'd see these billboards, and they were national debt billboards, and there were these clocks, and they would just run, right? And if I'm not mistaken, we're at a point now where national debt is exceeding GDP or real close to that, if not the case. And national debt is one of those things where it's this, I don't know how to describe it. It's this thing that people think about but don't understand how it actually ties to the real economy, right? It sounds bad, right? It's like, oh my gosh, we're running a deficit or we're running a surplus, and we think about it in layman's terms like our own budget. It's like, wow, if I had that much debt, that can't be a good thing. And I know there are some economists who have a perspective that the government can print as much money as they want, and there's really no negative impacts. There's people on multiple sides of this. My question for you is, as we look at the housing market in particular, and we think about the possibility of passing another multi-trillion-dollar stimulus package, what is the connection, if any, to sort of this notion of national debt and the housing market and mortgage rates and all of that? And I'm curious about that because I think it ties into bond markets, and I think it ties into securities that are held by foreign governments, like there's or treasuries, I should say. Like there's lots of things that are tied into this, and as part of my effort to grow our collective knowledge here, can you share a perspective on that?
Sure, and I think that's another important question, but you're right. Sometimes it's so abstract in nature, or at least wrapped in a lot of abstract language, that it's sometimes easy to just feel obfuscated by what many people are saying. So to maybe simplify it a bit, think of if you think of the federal government as simply someone who can borrow money and in exchange has to pay that money back. Let's start with that, right? So the federal government generally, to finance any program, it has to generally pay for that program somehow. And many times, because it's spending habits, like a good household that wants to enjoy the good life, even if it has to pay for it later, it likes to borrow more today than it has in store. So
Yes.
the government borrows that by generally issuing bonds. They can be, to your point, 10-year, 20 or 30-year, or shorter term, 6 month. You have treasury notes, right, which are basically promissory notes that we're going to repay this debt with an interest. The government's main source of revenue, on the other side, sort of like, for a household, it would be salary, income, whatever it is from, generally speaking, from taxes, whether it's income taxes, whether it's import duty taxes, and so on. But let's simplify it. The government pays for every program and every spending from taxes. And those taxes come from us individually and us collectively as corporations and so on. So the national debt, simplified, is the government generally tends to borrow more money than it has, so it can spend more today with the understanding they will pay for it later. That in and of itself is not difficult. Where the difficulty comes is when the government has to face, in essence, a variable interest rate, right? So like, unlike, we borrow money for a home at a fixed rate for 30 years, right? The government has 6-month notes, 1-year notes, 10-year notes, 30 notes. So for all kinds of debt periods, it has to factor that interest rates will change.
Right.
And this is where, for many people, the national debt becomes a concern. Why? The government borrowed a lot of money this year specifically to address this pandemic-induced recession. To your point, GDP as share of, national debt as share of GDP is at the highest level since practically World War II, when there was a massive effort to obviously finance the war effort. The silver lining to this massive debt is that the interest rate the government is facing, right? Many times what the government does, borrows through the Federal Reserve System, it's basically close to zero. So in essence, repaying that debt is not a problem right now. The concern is if the interest rate goes up 1, 2, 3, 4, 5%, all of a sudden servicing that debt becomes a lot more expensive, and the government has to resort to measures like increasing taxes. Furthermore, there's a combination of factors here that help a government or hurt it. Let's start with the help. If the economy rebounds very strongly and you have strong economic gain, that translates immediately to higher wages, higher income taxes. The government gains just by us living and producing more, right? So it can easily service debt. Conversely, if there's an economic recession, the government is going to collect less money. That now all of a sudden puts pressure. Furthermore, a lot of government debt is being bought by American consumers, American institutions, and as you pointed out, by foreign institutions. A lot of central banks around the world are buying US government debt because it's rated as excellent. As long as these institutions continue to buy debt, the government can continue spending. For a lot of folks in stock and bond markets, the concern is if some of these buyers are no longer trusting that the federal government can service that, they'll stop buying, which is going to put pressure. So without conflating these anymore, I think that looking forward, the important thing is to keep in mind 3 things. Number one, as long as interest rates remain low, the government will be able to service its debt fairly well. As long as the economy grows, the government will have the benefit of higher income taxes and will be able to service that debt without a whole lot of pressure. Conversely, and this is number 3, if any of those interest rates go up quickly, or the economy does not improve quickly, there will be a lot more pressure on the government to raise taxes. And so, to me, this is the period in which a lot of people, to your point, regardless of who's controlling the levers of policy making, when it comes to repayment of debts, at some point taxation comes into play. And so, from my perspective, barring an improvement in low rates plus a growing economy, at some point the government will have to make changes to its rate of taxation.
That's fantastic. Well, that's not fantastic, but your explanation was fantastic. Let's be clear. George, thank you for doing that. Again, I think these things are helpful, right? These are really important concepts that I want to make sure that everybody watching understands because they have a very real bearing and impact on our daily lives and our business, and as you pointed out, the taxes we pay and all of that. So. George, it's already been 25 minutes, which is hard to believe. So I think we'll wrap up for today. Is there anything that I didn't touch on that you wanted to cover in today's episode?
So the one thing I wanted to just quickly point to is we are tracking the rental market. We chatted a little bit about renters in our conversation, and that's one aspect of the market that we are starting to track. We're looking at rents across the country, and specifically for the top 100 largest metros. And interestingly, we are seeing some of the trends we saw in the for sale market also playing out in the rental market. Meaning, in the wake of the pandemic, a lot of Americans have discovered that wherever they lived is no longer sustainable, given that we not only have to work, but have to school kids, work out, have a gym at home, and so on. So it seems that for a lot of renters, this reality very much is playing out. So preferences are shifting in the rental market towards more space. And the report we just put out this week points out to that. Renters are trading up towards larger units. In addition, the same geographic dispersion we saw in the for sale market, where the need to be closer to nature, closer to a less dense area, is also pushing renters towards affordability. And so we're seeing markets away from the coastal areas that are gaining in rent due to higher demand, whereas high density, expensive coastal markets are seeing sharp drops. So think of San Francisco, think of New York and Manhattan specifically. We're seeing steep declines in rents, with areas more inland like Tulsa, Oklahoma, for example, and even in California. Let's pick the Bay Area, whereas San Francisco County is seeing steep declines. Contra Costa, Sacramento, Fresno are actually seeing bump ups in rent. Clear indication that renters are also looking for affordability and the other attributes that home buyers are also looking at. So to me, this will be an interesting space to watch as well over the next year.
I think that's really helpful. Thank you for bringing that up. And George, just so that our viewers understand this, you have your weekly housing trends view. Is there a separate publication about the rents that you're now tracking, or is it included in that?
So it's a separate. We're doing it monthly. We started with the September data. And we're going to go forward tracking on a monthly basis how rents are changing, as I mentioned, across the country and, of course, in the top 100 metros, and trying to see how the rental market is faring during this period. Because alluding to our earlier discussion, this is an important segment and one in which obviously a lot of Americans are obviously living their lives, and there's a lot of pressure on this segment of the market as well right now.
Absolutely. No, that makes a lot of sense. Thank you for sharing that, George. And as always, thank you for being so gracious with your time and sharing all of this information. It's tremendously helpful to all of the agents who are listening right now. And I can't thank you enough. I enjoy these conversations. I look forward to them, and thank you.
Likewise, Randy, a real pleasure chatting with you always, and glad to know that your agents are interested in some of this content.
They very much are. All right, George. Well, I'm sure we're going to talk to you again real soon.
Have a great rest of your week.
Thank you. You too. All right. Well, there you have it. Another great episode with George. I just love talking to him. He makes this accessible, I think, and he has a wealth of knowledge. And so hopefully all of you are paying attention and listening. And links below to the weekly housing trends view, the Realtor.com YouTube channel. Make sure you get signed up for that newsletter because this information is important. If you have any questions, post them below. We'll do our best to get you answers. And until tomorrow, be safe, be healthy, be happy, and we'll see you soon.